Hello there. Welcome to video 129 from Sumit Academy. May I wish all my subscribers and viewers a Merry Christmas, and I pray that the Lord blesses us all with peace, happiness, and good health. I do hope that you have subscribed to my channel. Do subscribe now so that you do not miss out on my previous or future videos. And do remember to like and share this video. And if you want to drop in a line, I shall always be available at sumitacademy20@gmail.com. To make your task a little easier, here is a complete list of all the 129 videos available on my YouTube channel. The list is divided into the playlists under which they are available. Do have a look. In this video, we shall talk about GDP or Gross Domestic Product. Gross Domestic Product is the total monetary or market value of all the finished goods and services produced within a country's borders in a specific time period. As a broad measure of overall domestic production, it functions as a comprehensive scorecard of a given country's economic health. We may say that GDP provides an economic snapshot of a country, used to estimate the size of an economy and growth rate. GDP is the most commonly used measure of economic activity and serves as a good indicator to track the economic health of a country. Though GDP is typically calculated on an annual basis, it is sometimes calculated on a quarterly basis as well. The first basic concept of GDP was invented at the end of the 18th century. The modern concept was developed by the American economist Simon Kuznets in 1934 and adopted as the main measure of a country's economy at the Bretton Woods Conference in 1944. Now, what does the word gross in gross domestic product stand for? Gross indicates that products are counted regardless of their subsequent use. A product can be used for consumption, for investment, or to replace an asset. In all cases, the product's final sales receipt will be added to the total GDP figure. In contrast, net doesn't account for products used to replace an asset in order to offset depreciation. Net only shows products used for consumption or investment. So that is the difference between gross and net. Next, what does domestic in gross domestic product stand for? Domestic indicates that the inclusion criterion is geographical. Goods and services counted are those produced within the country's borders regardless of the nationality of the producer. For example, the production of a Chinese owned factory in India will be counted as part of India's GDP. And finally, what does product in gross domestic product stand for? Product stands for production or economic output of final goods and services sold on the market. So what all is included in GDP? Only sales of final goods are counted because the transaction concerning material used to make the final goods. For example, the purchase of wood used to make a chair is already incorporated in the final total price. That is the price at which the chair will be sold. Next question. What is not included in GDP? Well, unpaid work, that is work performed within the family, volunteer work, non-monetary compensated work, goods not produced for sale in the marketplace, bartered goods and services, black market and illegal activities, transfer payments, sales of used goods and intermediate goods and services that are used to produce other final goods and services are not counted in GDP. Since GDP is based on the monetary value of goods and services, it is subject to inflation. Rising prices will tend to increase a country's GDP, but this does not necessarily reflect any change in the quantity or quality of goods and services produced. Thus, by looking just at an economy's nominal GDP, it can be difficult to tell whether the figure has risen as a result of a real expansion in production or simply because prices rose. Now, economists use a process that adjusts for inflation to arrive at an economy's real GDP. By adjusting the output in any given year for the price levels that prevailed in a reference year called the base year, economists can adjust for inflation's impact. This way, it is possible to compare a country's GDP from one year to another and see if there is any real growth. Real GDP is calculated using a GDP price deflator, which is the difference in prices between the current year and the base year. For example, if prices rose by 5% since the base year, the deflator would be 1.05. Nominal GDP is divided by this deflator, yielding real GDP. Nominal GDP is usually higher than real GDP because inflation is typically a positive number. Real GDP accounts for changes in market value and thus narrows the difference between output figures from year to year. If there is a large discrepancy between a nation's real GDP and its nominal GDP, this may be an indicator of either significant inflation or deflation in its economy. Nominal GDP is used when comparing different quarters of output within the same year. When comparing the GDP of two or more years, real GDP is used. This is because, in effect, the removal of the influence of inflation allows the comparison of the different years to focus solely on volume. So far, so good. Now, how is this GDP calculated? Well, GDP can be determined via three primary methods. All three methods should yield the same figure when correctly calculated. These three approaches are often termed the expenditure approach, the output or production approach, and the income approach. First, the expenditure method. This measures the total expenditure incurred by all entities on goods and services within the domestic boundaries of a country. A little bit of maths. So here GDP is equal to C, that is consumption expenditure, plus I, that is investment expenditure, plus G, that is government spending, plus X minus IM, that is exports minus imports, that is net exports. Let's have a detailed look at these terms. Consumption refers to private consumption expenditures or consumer spending. Consumers spend money to acquire goods and services such as groceries and haircuts. Consumer spending is the biggest component of GDP. Consumer confidence, therefore, has a very significant bearing on economic growth. A high confidence level indicates that consumers are willing to spend, while a low confidence level reflects uncertainty about the future and an unwillingness to spend. Government spending represents government consumption, expenditure, and gross investment. Government spend money on equipment, infrastructure, and payroll. Government spending may become more important relative to other components of a country's GDP when consumer spending and business investment both decline sharply. Now, this may occur in the wake of a recession. For example, investment refers to private domestic investment or capital expenditures. Businesses spend money in order to invest in their business activities. For example, a business may buy machinery. Business investment is a critical component of GDP since it increases the productive capacity of an economy and boosts employment levels. Net exports refers to a calculation that involves subtracting total exports from total imports, that is X minus IM. The goods and services that an economy makes that are exported to other countries less the imports that are purchased by domestic consumer represents a country's net exports. All expenditures by companies located in a given country, even if they are foreign companies, are included in this calculation. The second way to measure GDP is the production or the output approach. The production approach is essentially the reverse of the expenditure approach. Instead of measuring the input costs that contribute to economic activity, the production approach estimates the total value of economic output and deducts the cost of intermediate goods that are consumed in the process, like those of materials and services. Whereas the expenditure approach projects forward from the costs, the production approach looks backward from the vantage point of a state of completed economic activity. In other words, this measures the monetary or market value of all the goods and services produced within the borders of the country. In order to avoid a distorted measure of GDP due to price level changes, GDP at constant prices or real GDP is computed. Now, GDP as per the output method is equal to the real GDP. That is GDP at constant prices minus taxes plus subsidies. Take a minute to understand this. And finally, the third method is the income approach. This approach represents a kind of middle ground between the two other approaches to calculating GDP. The income approach calculates the income earned by all the factors of production in an economy, including the wages paid to labor, the rent earned by land, the return on capital in the form of interest, and corporate profits. The income approach factors in some adjustments for those items that are not considered as payments made to factors of production. For one, there are some taxes such as sales taxes and property taxes that are classified as indirect business taxes. In addition, depreciation, a reserve that businesses set aside to account for the replacement of equipment that tends to wear down with use, is also added to the national income. All of this together constitutes a given nation's income. In other words, it measures the total income earned by the factors of production, that is labor and capital, within the domestic boundaries of a country. Thus, GDP as per the income method will be GDP at factor cost plus taxes minus subsidies. In India, contributions to GDP are mainly divided into three broad sectors: agriculture and allied services, industry and service sector. We measure our GDP as market prices, and the present base year for computation is 2011-12. The exercise of base year revision of national accounts is guided by the ACNAS. Yes, that is called the Advisory Committee on National Accounts Statistics. Now, this comprises experts from the central and state governments, academia, the Reserve Bank of India, and other domain-specific experts. The ACNAS has recommended to the government to consider 2021 as the next base year of national accounts in view of the structural reforms in the economy. As per the United Nations System of National Accounts 2008, member countries are required to revise the base year of their macroeconomic indicators like GDP, gross value added index of industrial production, and consumer price index. Now, even though GDP is a widely used metric, are there any other ways of measuring the economic growth of a country? Yes, we have some more metrics too. While GDP measures the economic activity within the physical borders of a country, whether the producers are native to that country or are foreign owned entities, the gross national product, the GNP, is a measurement of the overall production of persons or corporations native to a country, including those based abroad. Now, GNP excludes domestic production by foreigners. Gross national income, GNI, is another measure of economic growth. It is the sum of all income earned by citizens or nationals of a country, regardless of whether or not the underlying economic activity takes place domestically or abroad. The relationship between GNP and GNI is similar to the relationship between the production, that is the output approach, and the income approach used to calculate GDP. GNP uses the production approach while GNI uses the income approach. With GNI, the income of a country is calculated as its domestic income plus its indirect business taxes and depreciation, as well as its net foreign factor income. The figure for net foreign factor income is calculated by subtracting all payments made to foreign companies and individuals from those payments made to domestic businesses. In an increasingly global economy, GNI has been put forward as a potentially better metric for overall economic health than GDP. Now, because certain countries have most of their income withdrawn abroad by foreign corporations and individuals, their GDP figures are much higher than the figure that represents their GNI. There are a number of adjustments that can be made to a country's GDP in order to improve the usefulness of this figure. For economists, a country's GDP reveals the size of the economy but provides little information about the standard of living in that country. Part of the reason for this is that population size and cost of living are not consistent around the world. For example, comparing the nominal GDP of the United States to the nominal GDP of India would not provide any meaningful information about the realities of living in those countries because of vast population differences. To help solve this problem, statisticians sometimes compare GDP per capita between countries. GDP per capita is calculated by dividing a country's total GDP by its population. And this figure is frequently cited to assess the nation's standard of living. Even so, the measure is still imperfect. Now, suppose China has a GDP per capita of $1,500, while Ireland has a GDP per capita of $15,000. This doesn't necessarily mean that the average Irish person is 10 times better off than the average Chinese person. GDP per capita does not account for how expensive it is to live in a country. Purchasing Power Parity (PPP) attempts to solve this problem by comparing how many goods and services an exchange rate adjusted unit of money can purchase in different countries. Comparing the price of an item or basket of items in two countries after adjusting for the exchange rate between the two in effect. Real per capita GDP adjusted for purchasing power parity is a heavily refined statistics to measure true income, which is an important element of well-being. An individual in, let us say, Switzerland might make $100,000 a year, while an individual in Japan might make $50,000 a year. Now, in nominal terms, the worker in Switzerland is better off. But if a year's worth of food, clothing, and other items cost 3 times as much in Switzerland than in Japan, the worker in Japan has a higher real income. So, how is this GDP data used? GDP's market impact is generally limited since it is a backward looking and a substantial amount of time has already elapsed between the quarter end and GDP data release. However, GDP data can have an impact on markets if the actual numbers differ considerably from expectations. As GDP provides a direct indication of the health and growth of the economy, businesses can use GDP as a guide to their business strategy. Government entities such as the RBI use the growth rate and other GDP stats as part of their decision process in determining what type of monetary policies to implement. If the growth rate is slowing, they might implement an expansionary monetary policy to try to boost the economy. If the growth rate is robust, they might use monetary policy to slow things down in an effort to ward off inflation. Real GDP is the indicator that says the most about the health of the economy. It is widely followed and discussed by economists, analysts, investors, and policymakers. The advance release of the latest data will almost always move markets, though that impact can be limited as noted before. Investors watch GDP since it provides a framework for decision making. The corporate profits and inventory data in the GDP report are a great resource for equity investors, as both categories show total growth during the period. Corporate profits data also displays pre-tax profits, operating cash flows, and breakdowns for all major sectors of the economy. Comparing the GDP growth rates of different countries can play a part in asset allocation, aiding decisions about whether to invest in fast growing economies abroad And if so, which ones? One interesting metric that investors can use to get some sense of the valuation of an equity market is the ratio of total market capitalization to GDP expressed as a percentage. The closest equivalent to this in terms of stock valuation is a company's market cap to total sales or revenues, which in per share terms is the well known price to sales ratio. Beginning in the 1950s, some economists and policymakers began to question GDP. Some observed, for example, a tendency to accept GDP as an absolute indicator of a nation's failure or success, despite its failure to account for health, happiness, inequality, and other constituent factors of public welfare. In other words, these critics drew attention to a distinction between economic progress and social progress. However, most economists held firm to the belief that GDP is an absolute indicator of economic success, claiming that for every increase in GDP, there would be a corresponding drop in unemployment. So, what are these shortcomings? Well, firstly, it ignores the value of informal or unrecorded economic activity. GDP relies on recorded transactions and official data, so it does not take into account the extent of informal economic activity. GDP fails to account for the value of under the table employment, black market activity, or unremunerated volunteer work, which can all be significant in some nations. It also cannot account for the value of leisure time or household production, which are ubiquitous conditions of human life in all societies. Secondly, GDP is geographically limited in a globally open economy. It does not take into account profits earned in a nation by overseas companies that are remitted back to foreign investors. This can overstate a country's actual economic output. Thirdly, it emphasizes material output without considering overall well being. GDP growth alone cannot measure a nation's development or its citizens' well being. For example, a nation may be experiencing rapid GDP growth, but this may impose a significant cost to society in terms of environmental impact and an increase in economic or rather income disparity. Fourth, GDP ignores business to business activity. It considers only final goods productions and new capital investment and deliberately nets out intermediate spending and transactions between businesses. By doing so, GDP overstates the importance of consumption relative to production in the economy and is less sensitive as an indicator of economic fluctuations compared to metrics that include business to business activity. Fifth, GDP counts costs and wastes and as economic benefits. It counts all final private and government spending as additions to income and output for society, regardless of whether they are actually productive or profitable. Now, this means that obviously unproductive, or even destructive activities are routinely counted as economic output and contribute to growth in GDP. For example, this includes spending directed toward extracting or transferring wealth between members of society rather than producing wealth. Now, such as the administrative cost of taxation or money spent on lobbying and rent seeking. Spending on investment projects for which the necessary complementary goods and labor are not available, or for which actual consumer demand does not exist, and spending on goods and services that are either themselves destructive or only necessary to offset other destructive activities rather than to create new wealth, such as the production of weapons of war or spending on policing and anti crime measures. So, what is the bottom line? Now, in their seminal note textbook, Economics, Paul Samuelson and William Nordhaus neatly summed up the importance of the national accounts and GDP. They liken the ability of GDP to give an overall picture of the state of the economy to that of a satellite in space that can survey the weather across an entire continent. In conclusion, we may say that GDP enables policymakers and central banks to judge whether the economy is contracting or expanding, whether it needs a boost or restraint, and if a threat such as a recession or inflation looms on the horizon. Like any measure, GDP has its imperfections. In recent decades, governments have created various nuanced modifications in attempts to increase GDP accuracy and specificity. Means of calculating GDP have also evolved continually since its conception so as to keep up with evolving measurements of industry activity and the generation and consumption of new emerging forms of intangible assets. Well, that's all from me in this video. This video is based on the information freely available on the internet. No originality is claimed for the same. The intention of this video is only to prepare candidates for answering examination questions on the subject and not for any financial gain. Do like and share this video and do subscribe to my channel now so that you do not miss out on my previous or future videos. And if you wish to drop in a line, I shall always be available at sumitacademy20@gmail.com. Till later then, cheerio.